Exchange rates serve as the cornerstone of global trade, influencing the cost of goods, international investments, and the economic stability of nations. Let's break this down in detail, along with examples to illustrate each point. Exchange rates determine the price of one currency in terms of another. They directly impact how expensive imports and exports are, shaping trade balances and economic growth. Fixed exchange rate is a system where the value of a currency is pegged to another currency or a commodity like gold. Historically, the gold standard ensured that the value of the US dollar was tied to a specific amount of gold. Another example is China's yuan, which is partially pegged to the US dollar, allowing some stability while also permitting controlled fluctuations. Floating exchange rate allows the currency's value to be determined by supply and demand in the open market. The US dollar, euro, and Japanese yen operate on a floating exchange system, meaning their value constantly changes based on market forces. Managed float, also known as a dirty float, is a system where governments occasionally intervene to stabilize sharp fluctuations, while still allowing market forces to dictate exchange rates. India's rupee follows a managed float system, with the Reserve Bank of India stepping in when the rupee experiences excessive volatility. Several economic and political factors determine currency values. Higher interest rates attract foreign investors looking for better returns, increasing demand for that currency. For example, if the U.S. Federal Reserve raises interest rates, investors move funds into U.S. assets, boosting demand for the dollar. Inflation rates play a significant role in exchange rate fluctuations as well. Countries with lower inflation see their currency strengthen because their goods remain competitively priced internationally. If India's inflation rate rises significantly, while Japan's remains low, Indian products become more expensive globally, reducing rupee demand. Political stability encourages foreign investments and enhances economic confidence. During political crises like Brexit, uncertainty caused the British pound to fluctuate wildly. Trade balance, which compares exports and imports, also influences exchange rates. A country with a trade surplus has high demand for its currency because foreign buyers need it for transactions. Germany, known for strong exports, regularly sees appreciation of the euro due to trade surpluses. Exchange rates affect everyday life, from the price of imported electronics to the cost of foreign vacations. If the Indian rupee depreciates against the US dollar, iPhones and imported cars become more expensive in India, while Indian exporters benefit since their goods become cheaper in foreign markets.